All right, let's dive right into this explainer. Today, we're putting grocery giant Kroger through the ultimate valuation gauntlet. We're going to act as expert investment analysts, strip away all that daily market noise, grab Kroger's latest financial filings, and just run the cold, hard numbers to figure out what this stock is really worth.
Here is our game plan for today. We'll start with a quick company snapshot, then run those financials through the legendary lenses of Warren Buffett, Peter Lynch, and Benjamin Graham before wrapping up with modern DCF models and our final verdict. Let's get to it. Section 1. Kroger, the company snapshot.
We are analyzing the Kroger Co., ticker KR. As you probably know, they're one of America's absolutely largest retailers, literally serving over 11 million customers every single day. Right now, they're navigating a pretty complex market environment under CEO Greg Foran, who stepped in recently to really help reset the business. There is a massive tug-of-war happening with the stock's narrative right now. On the bull side, well, adjusted e-commerce sales jumped 19% in Q1. They actually hit e-commerce profitability way ahead of schedule, pumping out a robust $2.8 billion in free cash flow. But then there's the bear case. We're talking serious investor concerns about pricing pressures squeezing their margins, plus the giant dark cloud of litigation tied to that blocked Albertsons merger. So who wins out here? Let's find out.
Section 2. The Warren Buffett lens.
You know, Buffett loves a business he can easily understand. And groceries? Yeah, they definitely fit the bill. Kroger actually checks a lot of his famously strict boxes. The economic moat is moderate, sure, but it's heavily defended by massive scale and this highly profitable retail media network driven by omni-channel data. Management seems honest and is squarely focused on store improvements. Earnings, super consistent, pulling in an adjusted FY25 EPS of $4.85. And crucially, their debt is totally manageable. Their net total debt to adjusted EBITDA ratio is sitting at a very healthy 1.75. Honestly, not bad at all for a company selling milk and eggs, right?
But you know Buffett, he ultimately cares about owner earnings. So let's crunch the numbers. If we take their projected $2.8 billion in free cash flow and divide it by their 615 million diluted shares outstanding, we get an approximate owner earnings of $4.55 per share. Now, if Buffett wants a 20% margin of safety on that cash generation, he's probably going to be looking for a buy price right around $45 a share.
Section 3. The Peter Lynch lens. Lynch would take one look at Kroger and instantly label it a classic stalwart. Look, this isn't some high-flying, hyper-growth tech stock. With Q1 identical sales without fuel up just 1.0%, they are a slow and steady ship. But they give you a rock-solid balance sheet and serious downside protection during recessions. Because, hey, people still need to eat.
To hunt for value, Lynch always went straight to the PEG ratio, price to earnings divided by growth. To run this, we do need to fill a slight gap in the data, so let's assume a current hypothetical share price of $50 and factor in a moderate 7% expected earnings growth rate based on their historical trend. Do the math, and we get a PEG ratio of 1.47.
So what's the big takeaway here? Because that 1.47 PEG is above Lynch's ideal 1.0 threshold, he definitely wouldn't call this a screaming hidden bargain. He'd likely rate it a hold, valuing the stock way more for its defensive stability and strong institutional ownership, rather than expecting any explosive upside.
Section 4. The Benjamin Graham lens. Graham was notoriously strict, but if we look at his defensive investor checklist, Kroger performs beautifully. Adequate size? Easy pass, with over $46 billion in Q1 sales alone. Strong financial condition and earnings stability? Pass and pass. A reliable dividend record? Yep, they paid out $1.34 per share last fiscal year. And assuming our $50 share price against $4.85 in earnings, they have a very moderate PE of roughly 10.3.
But Graham was all about the hard math, right? He relied on a very specific equation to find intrinsic value. So what actually happens when we plug Kroger's numbers into his legendary formula?
Okay, Graham's formula is the square root of 22.5 times EPS times book value per share. Assuming an industry-standard book value of $18 per share alongside our $4.85 EPS, the formula spits out an intrinsic value of exactly $44.32. But wait, Graham always demanded a massive margin of safety, usually around 33%. So to ensure near zero downside risk, he'd want to buy this stock closer to $30 a share. Talk about strict.
Section 5. DCF and Alternative Models.
Let's bring things back to modern Wall Street and build our DCF base case. We start by taking that $2.8 billion free cash flow projection. We'll assume a highly conservative 2% terminal growth rate for the grocery sector, and then we discount those future cash flows back to the present using an assumed 7% weighted average cost of capital. Finally, divide all of that by the 615 million shares outstanding.
Now, you know small assumptions change absolutely everything in a DCF, which is exactly why we ran a sensitivity table. Adjusting the WACC and terminal growth even slightly swings the value a lot. But our central base case, that 7% WACC and 2% growth, puts Kroger's fair value right around $59.80 per share.
And we can easily back that up with a couple of alternative models to validate our DCF. If we apply a standard 12x grocery industry PE multiple to an estimated forward EPS of $5.20, we get $62.40. Or, if we use a 6x enterprise value to EBITDA multiple against the rolling $8.18 billion in adjusted EBITDA, we arrive at $56.42. Notice how both models land in that exact same high 50s to low 60s ballpark?
Section 6, Synthesis and Final Verdicts.
All right, this master summary table reveals something super fascinating. Modern Wall Street models, like the DCF and comparable multiples, value Kroger fairly high, right up near $60 a share. But the stricter historical gurus, like Graham and Buffett, demand a steeper discount for safety. When you blend all these target buy prices together, the absolute sweet spot for a safe entry point averages out to the mid-40s.
Blending all of this together, here is our final verdict. Kroger has some incredible strengths: highly profitable digital sales, amazing free cash flow, and a really low debt ratio. But we cannot ignore the risks, namely that Albertsons merger litigation and the margin pressures they're facing to keep prices low for consumers. So at an assumed market price of $50, the stock is a solid hold. But it becomes a highly compelling buy if it drops below $45, because that's where that crucial margin of safety finally kicks in.
Ultimately, the mathematical models and the data are crystal clear, but the final, most important question is this. Does a slow-growing, predictable, cash-generating stalwart like Kroger actually fit into your personal portfolio? Or are you hunting for the next high-flying rocket ship? Take a hard look at your own risk appetite and decide if you need a reliable anchor for your investments. Thanks for joining me on this explainer. Keep analyzing, and I'll catch you next time.